Mutual fund investment is a popular way to invest in the financial market these days. It is an easy way to invest in the financial market and does not require active monitoring. Mutual fund is an investment management scheme in which an asset management company creates a pool of funds from many investors and invests them in various investment vehicles. The fund manager is a professional who manages the fund and invests the fund in multiple securities, stocks and bonds. The primary objective is to generate optimum returns by investing in securities that are in sync with the objective of the fund. Nowadays, investing in mutual funds has become easier as the process has gone online. Types of mutual funds. Here are the basic classifications of mutual funds based on objective, structure and nature of asset allocation. When classified on the basis of asset allocation, mutual funds are of three types: equity mutual funds, debt mutual funds and balanced mutual funds. Therefore, the investment risk depends on the scheme chosen. Equity mutual funds. Equity funds invest up to 65% of the capital in stocks of various companies, which means it offers the highest returns among all types of mutual fund schemes. The returns offered by equity funds are dependent on market movements, influenced by several ecopolitical events. Debt mutual funds. As the name suggests, debt funds invest in various debt instruments to generate a steady income for investors and hence are less risky. A debt fund invests up to 65% of the capital in debt vehicles. The market does not affect the performance of debt funds, hence it attracts risk-averse investors. Balanced mutual funds. Balanced or hybrid funds offer the best of both worlds. These funds invest in both equities and debt vehicles to generate attractive returns. Hybrid funds attract investors who are less risk-averse. The primary objective is to diversify the portfolio for a balanced risk return. Fund managers shift the fund between assets depending on the market conditions to optimize returns and benefit investors. Modern mutual funds are truly innovative products that offer a wide range of products to customers. Choose a mutual fund that suits your investment stance. How to invest in mutual funds online? The online process has made investing in mutual funds very easy. Here are the simple steps to follow while applying for mutual fund schemes online. Analyze your risk appetite and tolerance. The process of understanding the risk you are capable of absorbing is called risk analysis. The returns on mutual funds depend on the performance of the market. Therefore, before you invest, understand how much risk you can tolerate. The second step is asset allocation. After risk analysis, you should consider dividing your fund among various assets to create a diversified portfolio. Ideally, you should invest in both equities and debt funds for balanced returns. The next step involves researching the various mutual fund schemes available for investment to invest in different asset classes. These days, you can do your homework online. There are many websites to compare all the MF products available to you and make an informed decision. Choosing a mutual fund and applying online is the final step in investing in an MF. You can also consult offline, but the online process saves time and effort. It is essential to monitor your investments and diversification to ensure that they are in line with your goals. Benefits of investing in mutual funds. Investing in mutual funds offers many benefits such as flexibility, diversification, portfolio management by professionals and more. Here is a list of all the benefits of investing in mutual funds. Low cost compared to investing in the equity market. Investing in mutual funds is low cost, making it ideal for small investors. Mutual fund companies or asset management companies charge a small amount, called expense ratio, of between 0.5 to 2.5% of the investment amount. SEBI has set an upper limit of 2.5% for managing your fund. Goal-based investing. A wide product range allows investors to choose funds that suit their financial needs. Mutual funds offer schemes to meet short-term and long-term financial goals, matching personal risk appetite, investment horizon, and investment style. No lock-in. Unlike traditional investment options like FD, EPF, or NSC, mutual funds do not have a lock-in period. Low cost compared to investing in the equity market. Investing in mutual funds is low cost, making it ideal for small investors. Mutual fund companies or asset management companies charge a small amount, called expense ratio, of between 0.5 to 2.5% of the investment amount. SEBI has set an upper limit of 2.5% for managing your fund. Goal-based investing. A wide product range allows investors to choose funds that suit their financial needs. Mutual funds offer schemes to meet short-term and long-term financial goals, matching personal risk appetite, investment horizon, and investment style. No lock-in. Unlike traditional investment options like FD, EPF, or NSC, mutual funds do not have a lock-in period. In investment parlance, a lock-in period is a period during which investors cannot withdraw money or have to pay a premium for early exit. But most mutual funds are unlimited, meaning they do not have a lock-in period, although they come with different exit loads. Professional fund managers. Mutual funds are suitable for investors who do not have time to research the market or are not knowledgeable about equity market investment. By investing in mutual funds, they can avail the services of professional fund managers. These fund managers have excellent track records and a support team to help with market analysis and customized tips. Benefits of SIP. You can maximize the power of SIP by investing regularly in the share market through mutual funds and avail the benefits of rupee cost averaging. SIP refers to systematic investment through all market conditions to benefit in the long run. Mutual funds investments generally have very low limits, which makes them attractive to small and new investors. SIP reduces the need to set up a single lump sum fund for investing. You can choose the SIP frequency, ticket amount, and increase or decrease the SIP amount as per your needs. Fund switching choice. A good investor constantly monitors the performance of the funds and knows when to exit one option and when to invest in another. Mutual funds allow investors to switch funds to a better performing scheme, usually at a very low cost. Affordable portfolio diversification. When investing, portfolio diversification is essential. Mutual funds allow for low-cost portfolio diversification. It invests in stocks of different companies across multiple asset classes and reduces the risk concentration of the portfolio. When an asset class underperforms, asset managers ensure that the return ratio is high and risk is spread across other asset classes in the portfolio. Flexibility. Unlike traditional investment options, mutual funds offer flexibility such as investing through SIP, lock-in, and free fund switching. Due to these features, mutual funds attract a wide range of investors. With mutual funds, there is no need to time the market. Mutual funds allow investors to invest through SIP and enjoy the benefit of rupee cost averaging over the long term. You accumulate NAV, which is added to your portfolio as per the market condition. When the market is growing, you receive fewer units than when the NAV is low. Therefore, in the long run, the cost of the units purchased averages out. Therefore, with mutual funds, you can invest at any time, regardless of the market condition. Tax benefits. By investing in ELSS, you can avail the tax benefits offered by ATC. ELSS or equity-linked saving schemes are the only equity-linked investment plan which offers you tax benefit under ATC. Section 80C of the IT Act 1961 provides tax deduction up to Rs. 1,50,000 per annum. By utilizing the available limit, investors can save up to Rs. 46,800 annually by investing in MF. Regulated. Investing in mutual funds is regulated by SEBI and RBI. Also, the Association of Mutual Funds in India, AMFI, a self-regulatory body set up by all asset management companies, monitors the fund schemes and management. This makes investing in mutual funds safer as compared to other forms. Easy to track. Fund management companies publish regular reports and statements, making it easy for investors to track portfolio performance. If you invest in MFs through a third party, you can also use the performance tracker on their portal. Unlike equity investment, you do not need to monitor the market while investing through mutual funds. Final word. Mutual funds offer hassle-free investment opportunities to investors. Innovative product design, low capital entry, flexibility and professional fund management services are especially attractive to young and new investors who lack market research and experience. Apply for mutual funds now by following the online application process and start your investment journey today.